Hello everyone, my name is Stephen Fox. Welcome to my channel. The Michigan Consumer Sentiment Survey plunged by 10 points, which indicates that people's expectations for the economy are looking mighty dim. That's a 12% decrease. It was expected to come in at like 77, and it came in at 67, almost 10 points. A difference between the two. This is really a bad sign that people are not feeling good about this economy, no matter what they're being told. Consumers' inflation outlook increased to they expect 3.5% inflation, and that's an increase from 3.2%. So it jumped 0.3%, which is actually a huge increase in this short of a period of time. And it represents the highest level of inflation expectations since November of 2023. It definitely is not a good look when expectations for the economy decrease, but expectations for inflation increase. That was the highest number of jobless claims since August of 2023, and continuing jobless claims also increased significantly. So this is sort of the beginning of the unraveling of the economy when your jobless numbers increase significantly. So this data indicated that we were having more job losses, more people were losing their job. And this comes right after the previous week, we found out that we were adding the fewest jobs we had added in some time. Previously, like 300,000 a month were being added to the job rolls. And last week, only 175,000 jobs were added. So fewer jobs are being added and a lot more jobs are being lost. Not a good combination. It's sort of the old 1-2 punch. The number of jobs being lost is very significant. I suspect more significant than the number of jobs being added. It stings more when people lose their job. Piper Sandler has an indicator that has a perfect record for predicting the last 11 downturns. And it has to do with the percentage of people that lose jobs that become unemployed in a year's time. So you want to consider this Piper Sandler unemployed persons or people who lose their jobs, the number of job losses increasing by over 10% year on year as an early indicator. It usually precedes a recession by about 4 months, but it doesn't really get rocking and rolling until it increases like 20 or 30%. Stocks could still rise in the near term, and that's why it takes about 4 months for it to take effect. Right before a recession, stocks typically go up. They go up for a short period of time, and that period of time is about 4 months. So that's why they say it precedes a downturn by about 4 months. Looking at the chart, you can see that we just cracked above the number of job losses increasing by over 10%. It's like 10.5% increase from a year ago. So we're in the early warning stage. But as you look at that chart of all those downturns, boy, does it increase a lot, really, before a recession. I think when it gets like 20 to 30%, you want to get out of the market, probably, at least temporarily. But I don't think this is going to be a temporary thing. This recession has been very slow to come on, and I think it's going to be slow to come off, simply because assets have to be repriced, especially home prices. There are other signs that the economy isn't doing so hot. Airbnb, they had good profits, but it was their forecast that was in doubt, simply because they thought the number of rooms rented out would be relatively flat next quarter. The daily rate they thought would go up somewhat, but nothing too impressive. And they thought part of the reason things weren't better is because Easter occurred in the first quarter instead of the second quarter. So on a comparative basis, things did not look as good as maybe they should have. On the other hand, they did notice that the travel leisure demand was decreasing, or at least was moderating. They thought things to be relatively flat, nothing too exciting. So the travel leisure demand has been an uplift for the economy, and it looks like that is cooling down, at least somewhat. And things are not looking so good down on the farm. Farm equipment dealers are having trouble selling equipment simply because the prices of crops have fallen, so farmers have less extra money to spend on equipment. This is all good for inflation, okay? But it's not good for the economy, right? And that's why you get this dichotomy. And I think you got that 4-month lag. People will be excited initially about the coming cut in interest rates, but then when they realize the reason it's being cut is because the economy is going down, then that's where you start to lose face in the stock market. That's where I want to avoid this. I've been through this rodeo before. On the higher end of fashion, things are not looking so great either. Tapestry missed on revenue and had a poor forecast for future quarters. They sell handbags and leather footwear and other accessories. So this is an indication that demand is weak both in North America and in China for consumer discretionary purchases like handbags. So when you look at different areas of this economy, there's things that are starting to give signs, warning signs of what's to come, and I do not think it's good. I think this is very early, and I'm probably too early, but I would rather be too early than too late in a situation like this. Another indicator to me is how high of a cash pile Warren Buffett, the CEO of Berkshire Hathaway, how large his cash pile has increased, and he's not spending it on stocks. He doesn't believe stocks are cheap enough yet for him to make a major purchase. He's let the cash pile grow to $189 billion. He could buy like Boeing, with that cash. It's so huge. In fact, Elon Musk was astonished that the amount of money that Buffett is saving is equal to Elon Musk's total wealth. Elon Musk's total wealth is about $192 billion, making him the third richest person in the world. So we got some major events coming up. On Tuesday, the 14th of May, the PPI comes out. And on the 15th, the CPI, the Consumer Price Index, comes out on the 15th, and that's a Wednesday. And on Tuesday, the 14th, the PPI, the Producer Price Index, comes out. And that tends to forecast what the CPI is going to do. So we're going to get another 1-2 punch. And I expect the numbers, the PPI will probably be about the same, so it's no big deal. The CPI, I think, will either be the same or a little bit worse. And that's overall negative, even if it's the same, because the economy is getting worse. If the economy is getting worse and inflation isn't coming down, that's going to be bad for stocks. So I expect it to be a somewhat negative event for stocks. But I think, again, we got that 4-month lag. Probably stocks could go up here for a couple months, but I don't want to participate in it because I think it's too risky. So please like and subscribe because it really helps the channel, and comment because I really enjoy your comments and it helps me to think through my positions. Thanks a lot.